Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hey everybody, welcome to Vantage Point. I'm Andy.
Eric Susi.
Episode 46.
46.
Thursday, January 23rd. It's cold out there, man. Happy New Year.
Happy New Year to you. Yeah.
Thank you.
Got your warm outfit on?
Yeah,
Scraping the car windows?
That's what kids are for.
That's a good point. Yeah, I hear you. Good. Well, it's good to be back in the quarterly update here for Q1 2025. Time goes fast, doesn't it?
Yeah.
What happened Monday?
Yeah, national championship.
Yeah.
That was good to see.
Good to see. Double deucer, man. It's awesome.
That's right.
Yeah. So glad everything went out without a hitch and off and running. So here we are.
That's right. Yeah.
Well, good. Well, let me just jump in with a couple disclosures just so everyone's happy. So basically, if this information's been obtained, if I hold up papers and Andy and I, it's been obtained by a third-party source, we believe it to be accurate, but we cannot guarantee its accuracy or completeness. If we talk about asset classes, products, diversification, and anything like that, the following information is for general information only, and it's not intended to be specific investment advice. It's important to consult a financial advisor who understands your individual financial situation prior to making any investment decision. And again, when Andy and I talk, it's our beliefs, like our opinion, we believe. So those are all the little things we have to check off. So, all righty. Boom, let's get to it.
All right.
A lot going on. So I guess starting off, let's recap last year. So last year, it was incredible as far as, still narrow. Okay. So I'm going to start off with a chart. Basically, 2024, only 28% of the S&P 500 companies outperformed the index. Okay. So only 28% of the S&P 500 companies, there's 500 companies, outperformed the index. That's the narrowest since 2023, which at that time was 27%. And in those 2 years, again, were the narrowest since 1998 and 99. Okay. So again, that was 29% in 98 and 31% in 99. Again, this is the narrowest of companies outperforming the indexes. Basically, nothing new. And Nathan obviously is blown up on this, but the point is, it's just, again, those top 10 mega companies are still, leading the sleigh here. So, you have to be, a diversified portfolio. It works, but it doesn't work quite as nicely when
it's boring.
Yeah, it's boring. Yeah, that's exactly right. The turtle versus the hare, who wins the race? So, just want to recap last year. Again, risk-adjusted returns. That's what's nice about how we build models. Again, overall, our portfolios did well with less risk. So we're happy about that. Beating those benchmarks that we use, the Dow Jones portfolio moderate indexes, right?
That's right. Yeah, that's right.
So it's all good there. I guess getting into options, I know folks have heard me talk about this over the years, but this really sums it up nicely. Again, Nathan, our producer, will bang in on this one. Again, this is from Tier 1 Alpha, okay, one of the research centers that we use. It's part of Hedgeye. So with this, goes back to 2018. So less than 10% of the daily trading volume is 0 day to expiration. So back in 2018, less than 10%. Volume 0 day to expiration. Okay. You can see it growing up, go high. Then you can see this came out on 1/8/2025. So on January 8th, 2025, basically we were nudging on the door, knocking on like 59%. Well, it broke. Now they didn't update the chart, but officially on 1/14/2025, we hit 60% of all trading volume within the SPX option volume. It hit 60%. So basically we went from under 10% in 2018 to this year, January 2025, we hit 60% of trading volume expired same day, 0 days expiration. So that's incredible. It just shows the whiplash, back and forth of how things can move. So that's why his volatility both directions up and down. Mm-hmm. And again, that was from our partner there. So I just always like to point things out like that.
It's pretty risky daily options like that, buying volatile contracts, right?
Yeah.
Crazy.
So when the dam breaks, it breaks fast. That's the gamma and alpha, and they talk about all that and all that good stuff. But we track it all for you, so we make the models and adjust and tack when we need to tack. So again, leveraging with Sims too. You remember we talked about that, Stratus Investment Management and deepening our partnership with them too. Let me hit on this, I guess, inflation. So inflation nowcast just got produced this week. Again, Nathan will zoom in on this one. So this is nowcast. Follow the middle line there, the black, the base case. This will be produced here on February 12th, I believe is the next production of the CPI year over year. So that's coming out February 12th.
A little jump, huh?
Yeah, a little bit more of a jump. Yeah, 3.04. So again, the trajectory, the low is September, and we've been saying this for 4 or 5 months now. It's going to be higher, higher, higher. Not going down to 2. It's going to be north of 3, and here we are. So inflation's longer, stickier, for heading into 2025. So still something to in the quads 2. That's what we're in right now for January. So I think 3 of the next 4 months are going to be between quads 2 and 3. So 2 and 3. 2 just means economy is growing, but inflation stickier and higher. And quads 3 means economy is slowing, but inflation stickier and higher. So we're going to be back and forth between those quads 2 and 3 for the next 3-4 months. I guess moving on here in regards to again, forecasts. Forecasts. We don't really put too much credence into that.
Right.
So yeah, exactly. So last year, if you recall, I think it was J.P. Morgan Chase had the S&P down 12%. Okay, I remember there was like 24 firms, and JP was the lowest. Another firm was like up 13. The average, I believe, last year was 10% in the S&P. What they forecasted, well, it came in higher than that, obviously. This year, basically,
what's the average? Like 10, 8?
In regards for this year.
Yeah.
Bear with me here. Last year was 3. I'm sorry. Yes. Last year was 3% was the average. Sorry. This year is 10%. That's correct. Yeah, 10%. I misspoke on that, but yes. So 10% is the average. So we'll see. But we have, this is from First Trust. One of our guys that we lean on him, Brian Westbury. He has a range. He said, "quote We expect the S&P 500 to end 2025 between 5,000 and 5,000 and 5,400." And he says, "Let's say 5,200." So 5,200 is what he thinks it could end. So obviously it's downward from here. So that's why we're still going to have buffers and airbags plopped in there for the models, and just it should be positive. We don't see a recession, but just a lot of volatility is what.
All right. So as you could say, it's going to be somewhere between negative 50 and 100.
There you go.
I'm an economist.
There you go. Yeah. So it's all over the place as it is every year. But I always like to hit on that just so people know. All righty. Well, what do you have on your side there?
Yeah, just looking at some planning topics, right? So as you think about heading into the new year, like what are some things that you should have on the front of your mind or on your plate? And obviously thinking about if you are able to contribute to an IRA account, then you still have time to make a contribution for 2024.
Right.
So you have April 15th. And so you can always go, okay, as you're doing your taxes, does it make sense to go into the Roth? Are you able to make a contribution?
Are you eligible?
Are you eligible to get the tax deduction? If not, then maybe it makes sense to put money into the Roth if you can. If not, there are some backdoor options. There's some strategies. You can always make a non-deductible contribution. Right. You can put money into your
QCDs. We've been doing a lot of those.
Charitable.
So keep that up too. And then along with that, the annual gift exclusion for this year is increased. So it's $19,000 per person. So husband, wife, so that's 19 for the husband, 19 to the wife, can go to the child. So that's significantly increased over the years from 14, 15, 17, so 19,000, right. No paper trail, no nothing. So that's all good.
Yeah.
Awesome.
Yeah. And also there's a provision that went through the Secure Act. So if you're between 60 and 63 years old, you are able to make what's called a super catch-up contribution in your 401k plan. Right. So you can make an additional, it's actually, you can pour up to $34,750, into your work-based account, which is an additional $4,250 more.
That's pretty good.
That's what you previously could do in 2024. Yeah. So, so if you fall in that, hopefully we're catching it, or we can have those conversations to see if it makes sense to do that. So
for those who are 60 and 63 this year, you can plow more into your 401k. More. So it's giving a little bit of a window.
Yeah, if you're maxing it out.
Yeah. That's great.
So just be thinking of that. HSA contributions for the year. You know, the strategy of taking IRA money and rolling into an HSA. That's a great way to take tax money and make it tax free without penalties.
That's a one time, right?
Once in your life.
Once in your life, one time. So
yeah, but the thing is, you can do it for you and your spouse. So if you have a spouse even who's not working, but she or he is under your healthcare benefits, you have a high deductible plan, you have an IRA, and she or he has an IRA account. Well, you can do it 1 year for yourself, and then the next year do it for your spouse, wife, or
10 and 10. That's 20K you can do. That's awesome.
Yeah.
Cool. Good. All righty. Well, those are.
Yeah. Let us know. We can chat.
Yeah.
About
Well,
that.
that's great. Well, all right. Let's maybe just move into the tips of the month then.
All right.
Cool. So with the tips of the month, we'll start off with top performing sectors. So Nathan will see this one. So this is interesting too. Top performing sectors for the S&P 500. So Andy, what do you think? Past 5, 10, 15, and 20 years of all the companies, think of the crazy ones, the high flyers. Who's the leader that had the most return?
Let's say Big Lots.
Big Lots. Yeah, good one. Oh, I have a lot of clients that are there too. It's a shame. Rest their soul. But no, it's our favorite NVIDIA.
Yeah,
hello.
Of course. Yeah.
But that's just crazy. You can see this, folks, how 5 years, over 2,000, 10 years, 27,000, 15 years, 47,000 return, and 20 years, 92,000 return, over 92,000. So that's just crazy. This all comes from our chart, visual capitalist. So that's a little interesting tip of the month there. So, last year, this is from MFS. Again, just good information here. Too much of a good thing. So the S&P 500 last year registered 57 closing highs. It's the fifth most for a given year since 1953. So, higher. Remember, we started January last year. Our call, we talked about highs beget highs. You go higher, 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 and that's what happened. It just kept on rolling, even though there was two minor 5% pullbacks. But that was interesting. Bankruptcies again from MFS. So bankruptcies are on the rise. So for 2024, bankruptcies increased 8% to 686. It's the highest total since 828 companies filed in 2010. So 686 companies filed bankruptcy last year, highest since 2010. So again, remember the K-shaped economy we talk about, the have and have-nots. So unfortunately, we're still there. Over 60% of folks living paycheck to paycheck. So it's challenging. Our good old 529 programs.
Yeah.
So, we use them. They're great. State tax deduction, $4,000 per person. So be sure at least you put in $4,000 per child to take this top line state of Ohio tax deduction. Lifetime account limit, again, it increased effective 1/1/2025. You can put in up to $555,000 into Ohio 529 program. Whoever spends that much on the school, you're crazy. Anyways, just wanted to point that out and reiterate to our clients, please still utilize those. Those are great. Ohio 529 still around top 10 as they rank them, and they're excellent vehicle to tap into. And then for those who have leftover, you can do remember the Roth.
Yeah.
So
it's great. Finally.
Yeah, you can. Yeah,
smart.
Yeah, and use the K through high school too, K through 12.
Yeah.
And then obviously for college. So it's plenty of multiple benefits for that. Data centers. So data centers, the U.S., we have the most, folks. Okay. So data centers, 5,381 data centers. This came again from Visual Capitalist. So the U.S. leads it all. And you can see Asia, European countries. Germany's in second place at 521. UK is 514. China is 449. Yada yada yada. So
I wonder what kind of data.
It's what we have around here in Columbus. All those things they track everything.
Yeah.
What we say, talk, click on.
Sure.
That's how we get those targeted centers there. So scary. It's the AI Big Brother. It's here to stay. So. Yeah, and then they talk about also with this is the cost of energy computing, rising energy consumption. For the context, the average Chat GDP query requires 10 times more electricity to process than a traditional Google search. So again, according to Goldman Sachs research, data centers will be the largest driver of future U.S. electricity demand. By 2030, data centers will account for 8% of all total demand, up from 3% in 2022. So hence,
Wow.
There's nuclear reactors, uranium, small nuclear reactors we talked about, and they're Microsoft and 3 Mile Island, they want to have these sites right on site to produce their own power right there for that. So, that's interesting way of doing it.
Yeah, right.
All righty. That's some tips of the month, something a little different there. Let's move on to our favorite charts.
All
we like
right.
the visuals.
Let me get my pillow.
I know. You like, here we go. So let's flip through this. This will be fast. But again, this puts context into things of where we're at. So this is the stock PE ratio. Right now, this is as of January 21st. The PE now has come down some, which is good. It's a little lofty. It was well over, it was close to almost knocking on 23, the PE ratio. But right now it's 21.7. The average is 15.8. So again, it's a private price of the stock compared to its earnings forward guidance for this year. So stock market valuations, again, certain things, PE, price to book, price to sales, cash flow, dividend yield. You can see where we are today, the little diamond versus 1 year ago is the red X. Again, we're elevated, so lofty. So that's why I have to be careful. Still have a little, airbags, defensiveness built into things. Yield curve, this is a 2-charter. So the LEI is on the y-axis on the left side. So that's has come up off the bottom. It was, close to like 6-7% negative. Now it's only negative 3%. So it's had a nice little strong comeback of late, which is good. You want to get positive. These are leading indicators. It's over 12 data points that are leading economic indicators. So you want that to get positive. Somehow, no recession, wink, wink, but for the past over 2 years, but even though it's negative. Then you have the 2-year, 10-year spread. Remember, it was inverted for over 2 years. It has uninverted at the end of last year. Okay, right now it's positive 0.31. So that's a 2 10-year spreads positive. That's fine. But again, these gray shades, you can see after coming out of it, still could be bumpy. So keep in mind on that. Bond market volatility. Okay, bond market volatility. That's called the MOVE index. The average is 86. Right now it's at 90. You can see how it spiked up here at the end of last year and into this year. But again, it is still elevated slightly. It's the leading indicator. Typically, worked at the hero price. The bond market's an indicator for what's going to happen with the stock market. So I always follow the MOVE index. And that leads into the COB, the VIX, the volatility index for the equities. Right now it's 15.1. It spiked earlier this year, obviously in the mid-20s, or actually close to 30 almost. Yeah, 27 earlier in January. And the average is 18.3. Right now it's 15.1. So that's just the volatility over the next 30 days in the stock market. Pullbacks, 5% or more for the S&P 500. Again, the average is 4.5 times a year. You have a 5% pullback in the S&P. Last year we only had 2. That was April and August. That was it. So far, 0. We expect more volatility, more than 5% pullbacks in 2025. 10% pullbacks. Again, 10% pullbacks happen 1.2 times a year. That's the average. We didn't have one last year. We'll see. I am anticipating, my belief is we'll have a 10% pullback. Just part of it. So don't freak out. It's just part of it. CPI index, consumer price index, again, 2.9 is the latest read. Again, that excludes food and energy. When you do the core, excludes it's 3.2. So it's going north, going higher. The PCE is what the Fed focuses on. Again, they want that to get down to 2. The core is 2.8, again, approaching 3. And then I showed you earlier what the Hedge Eye nowcast is 3.04. For the January CPI print. So north of 3 is what we're saying, it's not 2. Personal savings rate. So personal savings rate, the average is 6.2. You can see the spike up of COVID, is over 20%. Right now it's at 4.4. It's been adjusted. They made some adjustments the back half of last year. They made some adjustments to this, but the point is, it's tight. People, it's they're tapped out. You got credit card debt, you got loan debt, you got student loan debt. Got over 36 trillion, so plenty of headwinds. But the good news is we have using lowly correlated asset classes, things that are out there that are going to provide some airbags for you. And hang in there. We appreciate you. More rebalancing for me is coming, so you'll see those trade confirmations come through. Also for Andy, it's for the first half for Q1 of this year, and then we'll go from there. So we appreciate you. All right, very much. You take care. Thank you.
Day.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. Opinions expressed in this podcast are for general information only and are not intended to be specific investment advice. It is important to consult a financial advisor who understands your individual financial situation prior to making any investment decisions. Some of the information contained herein has been obtained from third-party sources which are believed to be accurate, but we cannot guarantee its accuracy or completeness. The information should not be regarded as a complete analysis of the subjects discussed.